Welcome to the Dividend Talk podcast, episode 36. Consumer staples reporting their earnings. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us, and check out our previous episodes on YouTube and Spotify. See you on the inside. Good evening, European DGI. We are fresh off the news that Danone cut their dividend. I'm sure that's going to be a hot topic considering we kind of pioneer them quite a bit on the show. So I'm quite looking forward to a discussion on that in a little bit. But aside from that, how are you?
I'm really good. Friday, end of week, work my ass off. I think you did as well because you were a bit quiet on the social media platforms. But yeah, it was a really exciting week. So specifically about European companies this week, right? And that's why I'm so happy that we're talking about consumer staples, because consumer staples were all over the place here this week. So yeah, no, I'm really looking forward for the show today. Quite some earnings to discuss.
Nice. And before we get into any of that, I'm sure that might take up most of our time. What's going on in the world? Any news to share with us?
Well, you know, this thing about politicians, right, is really interesting. So I think it takes politicians really hard to figure out what to do with Trump. But when it comes to GameStop, they are really quickly. So they had some hearings this week, I think yesterday. And I really would love to share with you a little clip and get your thoughts on this. So give me a second. There we go.
Member McHenry, members of the committee. I'm happy to discuss with the committee my purchases of GameStop shares and my discussions of their fair value on social media. It is true that my investment in that company multiplied in value many times. For that, I feel enormously fortunate. I also believe the current price of the shares demonstrates that I've been right about the company. A few things I am not. I am not a cat. I am not an institutional investor, nor am I a hedge fund. I do not have clients, and I do not provide personalized investment advice for fees or commissions. I'm just an individual.
God bless the internet.
Can you imagine that you're in an official hearing in front of your whole parliament and you would say, I'm not a cat.
Wow, you have to link that in the description. I'm going to check out that full video. That's incredible.
And a straight face, right? No joke, straight face.
No joke, straight face. Brilliant.
Yeah, so this was my news from the week.
Yes, hey, it's a pretty good one. I haven't seen any of the news. I haven't even seen that video, but I'm certainly going to watch that and see how that transpires. But he was right. He is definitely not a cat, because we can see that. So fair play.
Have you discovered anything else in the news, or was it just work?
No, this week was just work. I wasn't getting home till late in the evening, but I spent a little bit of time this week with a couple of Irish guys, Irish investors. One of them is called Dave. He has a website, Fire Dave, and he hosts this kind of talk every couple of months. I was supposed to speak on it. I think it's in 2 weeks' time, but I can't make it. I'm away. I'm away that weekend with work, so I can't make it. But you should definitely check out the website. I'll link it below, and just check it out and see if you'd like to listen in. There's some good people on it. I don't know if you're aware of the Financial Independence Your podcast that I spoke on before.
Mm-hmm. Yeah.
Alvar is talking on it. Vince Doherty is he looks after the Irish WhatsApp group that I'm in. So there's a few good speakers. So any of my Irish listeners should definitely check it out. And yeah, that's about it. That's about it for me this week.
Cool. Thanks for that. So let's start now with our main topic from today. Earnings from our actually quite some stocks that we probably have in our portfolios, right? Because we'll be touching on Danone, Ahold, Delhaize, Nestle, Walmart. I mean, I guess half the globe is buying their food there on a daily basis. So
yeah, I think we'll have to start with Danone, don't we? We have to. Really, really frustrating that they cut the dividend, but we'll get to that. The first question I have is, when you're reading their report and their presentation, they talk about recurring, so recurring EPS, recurring net income, and then they have reported. And do you know what the difference in both of those are? Because I think it's really important to know when you're going through the report.
yeah, so this is again this thing about what is it, non-GAAP and such versus GAAP, and here it's called recurring. Other companies called constant. Others call it core. But if I'm correct about recurring, it is more there to do with the share dilution and such, and I guess stock-based compensation on the background. So, for this, I really always like to see the registration document. Yeah, when the full annual report is published, because then you see all the numbers really nice, clean. So, but to be fair, Danone usually reports pretty honest about their numbers. So
yeah, and to be fair, they do call out exactly, list out the differences in recurring earnings per share, recurring net income, and they do that further on. But I think it's important when you're going through these, because they like to talk about recurring EPS, because sometimes it's better than the actual reported. So it's just important to know when you're looking at them. But we'll have a look at the overview first of all. Their net sales was down 6.6% on a reported basis. I believe this was mainly down to currency impact, so the high currency impact. Like for like, it was actually down 1.5%, which is not too bad. They saw solid growth in their dairy and their plant-based products. Their nutrition and water wasn't so good. Water took a big decline, and look, we knew that was going to happen. The earnings per share, the reported earnings per share was actually up at 1%. The recurring was down 13%. And that's pretty much what they have in their overview. Their outlook, then they talk about a tough Q1 that they're going to have, and that they'll be back to growth in Q2 and then profit in second half.
What I'm noticing that Danone is all the time doing it's linking their forecast with their expectations to the vaccines. So I believe that they think about the second half of the year, that a majority will be vaccinated. The summer will come, people will want to go on holiday a bit again. So hence they will sell more water again here and there. I think that's why, and maybe it's a bit optimistic even. So you might want to be more conservative if you invest in Danone. But that's what I'm really reading when I read such text, because I wouldn't know elsewhere where they would get back to normal in the second half, because it's really the water business that is struggling.
You've read my mind, because I have a note wrote down. I've highlighted that and have a note, over optimistic. And as you read through the presentation or the press release, they speak a lot about the impact of COVID and the impact of lockdowns and restrictions in Europe. And I know from an Irish perspective, we're locked down until May. So we're not opening back up until May. And even at that, we'll be phasing back into it. So that's most of your Q2.
Yeah.
Still in lockdown. So I think they're being really, really over optimistic. I don't know if they're going to get back to profitability this year. So I just think they're overcompensating.
But they are profitable, right? I think we're talking about profitable growth.
Profitable growth,
yeah. Okay.
And also then they talk about what's going to grow, or their profitable growth ambition. And to me, they just talk a load of fluff. Investing in portfolio superiority and differentiation. I mean, what does that mean? We're gonna look at our hole in a few minutes, and we'll see the difference. And they make them statements, but they actually explain what they are. They don't explain what does that mean to an investor. I have it's just a load of nonsense. But they are holding a conference or an investor day on the 25th of March where they say they will talk about what these plans will be and will elaborate. So we kind of have to look forward until that day to kind of get a real handle on where they're going this year and next year. I suppose the key thing for me is, why did they cut their dividend by 8%? The free cash flow declined by 18%, nearly 19%. Why not use that? Why not cut it 19%? Why 8%? I don't understand it.
Well, and actually, if you look at their payout ratios, it's really good. I know that they have this policy for a certain payout ratio, but come on, if you have such a dividend history of more than 3 decades, why not just, they're not even leveraging up on debt or anything. They have a good balance sheet. They could have just increased the dividend with 5%. No issue at all. If they specifically if they believe in their own forecast, no issue at all. There was nothing for them to stop them to increase the dividend, and that's what I find really interesting, EMF, because later they say, and this quote I love it, and I saw you also caught it. So they say, in this context, we fully recognize that our share price is not where we would like it to be. And then it goes a little bit on, and then they say that it resumes our ability to dialogue openly with our shareholders in preparation of our important what is it? Is it Capital Markets Day?
Yeah,
when we will share more on the growth platform underlying our categories and countries, as well as our progress on our transformation plan. So what they're really saying, that they want to negotiate kind of with their shareholders to see, because there's another quote in another somewhere else in the report, and then I think like, okay, so if you realize that your share price went down from 80 to 50, and you know that your shareholders are grumpy, then why do you cut the dividend on top of that?
Yeah.
If they wanted to please us a little bit in these hard times when the share price low, then just reward the shareholders with the dividend, right? And show that safety there. So, I mean, for me, the CEO gets to the wall on shame. For me, he may join the guy from Unilever that cut the dividend by 1 cent in 1968. So he's the second person. I will make a wall of shame, I think, on my website for such CEOs.
Mm-hmm.
And he belongs there as well, because other than that, I find it actually quite a good CEO who seems to be on top of things. But this really makes me think about him, like, what an idiot.
Yeah, I can't like it wasn't a bad report all in all.
No,
most of it you could have predicted. We knew water was going to be heavily impacted, and they've done quite well in the plant industry or the segment, so it's not too bad. I mean, if they didn't increase, I wasn't even expecting them to increase. I wouldn't have minded if they held it, but I just can't understand what the difference 8% is. I mean, if they held it, they would have been in the low 60s in the payout ratio. They're what, 58%?
Totally
8%
fine.
now. Totally acceptable. And if they're going to get back to the growth that they say they will at the second half of next year, then it's not a problem. But yeah, it's baffling for me. But the question, I suppose, the real question, and I know you had an exchange on this on Twitter today, is does that mean you'll sell Danone right now?
I'm not going to answer that for this. I want people to wait till the listeners' questions,
okay,
and just listen to the rest of the show or skip forward. This will be our teaser and cliffhanger.
You should put the intro music back in here now.
Yeah, I will do that.
Okay, cool. So look, overall, it wasn't a bad year for them, but it just makes no sense cutting the dividend, and it's kind of annoyed me as a shareholder. It makes no sense. And look, we have to wait until the 25th of March for this investor day or the CME that they're holding to see their plans for the year ahead.
Yeah, what he effectively said is like, hey, EDI, I'm going to give you an 8% salary cut. Now, who gets happy from that?
I don't know, somebody with too much money.
Yeah, well, not me. Okay, let's go to the next company then, and that's Walmart. So, first of all, from Walmart, I think this is a perfect growth story, right? What the family is doing there, competition from Amazon. And then imagine that you're a supermarket chain as Walmart. You're literally on every corner in America, and everyone comes there with their trucks to load it up. So you know your whole market is saturated. Amazon passes along, and then you buy a tech company, GD, and you put all your faith in that. Now, talking about taking risk, I've seen only few companies doing that in the last years. One is Disney, where Disney says like, we're going to cannibalize all our revenue streams and double down on Disney Plus. And I have the same feeling with Walmart, what it's doing. And for me, this is something which I really appreciate. Not wait until everyone has eaten your lunch. No, just be on top of it, take the hit, take the beating, take the risk, and try it out. And this is also what you see reflecting in the numbers. Yeah. So if you then look at the numbers there, they don't look so good, but it is just because of all the investments that they are doing as well. Because their US e-commerce grew their sales with 69%. That's a lot, right? I know the base is maybe not so high yet, the baseline, but I find it really high. And comparable sales grew also with 8.6%. They had a negative EPS, Gaap Eps, and that's because they had quite a loss on their operations that they held for sale in the UK and Japan, which was around $2.50, and that's why they had a loss in their Gaap EPS. Their adjusted EPS is $1.40. So people ask me sometimes, why do I stick to Gaap EPS? Well, exactly for these reasons, because they bought these operations in the past. Probably they wrote in their reports there that this will be accretive straight away or in a year. And we often know that they're optimistic at that time. So, and then to ignore those again in the earnings numbers later on when they need to do the write-offs for me is just a little bit insane. And sometimes I just count all the earnings from the last 10 years on top of each other, and then see what they really earned over that time. And you get sometimes surprising figures. And I did it with IBM one time, and you see just a delta of 40 to 50%. And these are all just consequences of management decisions in the past. Anyway, having said that, I found the numbers quite good. What I appreciate in them, and I don't know if it's just political pressure or not, is that they are going to increase the wages to about $15 per hour. I think nobody should live under the poverty line in our world, in our society. And I think if a company starts doing this, I think they will also get more happy employees. And that's my thinking. And I like that in general. But the share price went down also quite a bit, I think 5 to 10%. And that's to do with their outlook, because they're heavily investing, doing some divestitures, and this will impact their sales and their EPS. And I think for the upcoming 2 years, you will just see that the EPS will hardly grow from Walmart. And this is also reflected in a 1 cent per quarter dividend increase. So I think the dividend increase was just 2%. So they just need all the money to invest in their digital business. That's really what it is about. And that's what their earnings show, actually.
Yeah, so they've posted quite a strong quarter, but then their future prospects is not as strong, so their share price drops. But that creates a nice buying opportunity, really. And I suppose this is the key difference between our US friends and companies and our European companies. They've increased the dividend. I know it's a token, it's a gesture by 1 cent, but I mean, and this is what's frustrating as a European. As the European, like our companies, they see this as an opportunity to cut it by 8%. But I mean, these guys over there just increase it, keep their investors happy, keep them on board, and It's what we fail to see. But no,
So I see on Twitter then some folks saying like, that's why I'm mainly investing in the US. But in the US, everyone got on their whole portfolio pay cut of 8% because of the currency exchange. Yeah. So, and this is something that for European investors is always so difficult. Yeah. So we want often some euros in our portfolio to stay in our native currency, to also mitigate the risk of having your whole full portfolio in the US dollar, which is generally weakening lately. So this is just a different culture, and we know it, right? It's nothing new. We know it. We see it in the figures. So
yeah, good point.
Okay. So that was about Walmart, but I also know that you looked into one of my favorite companies, Ahold Delhaize.
Yeah, and I was kind of forced to look into these a little bit because I have put options that are expired today, and it slightly below the price that I had of 23. So I now am the proud owner of 100 shares of Ahold, which I'm actually quite happy about. I think this is the third time that I've sold put options on them. So my cost average is still below what they're at the minute. So I could easily sell them and still be in profit, but I'm not going to. And I'll tell you why in a moment, because I'm quite happy with how they performed over the last year. We've seen some strong figures here, and yet their share price dropped maybe 2 or 3%, or even more since they released these earnings. So their sales were up 18% in Q4 and 14% in 2020 as a whole. But the online sales has been incredible. We've seen 84% growth in Q4 and 67% again in 2020. So that's quite something. I know they're investing a lot of money into their online platform and they're really pushing that. So it's nice to see that actually growing. The operating margin is about 4%, and that's kind of constant over the last couple of years, and they're hoping to do that again next year. The earnings per share was 53 cents in Q4, and it was 2.26 for the full year, which again isn't too bad. And their free cash flow was up a lot more than they forecasted. I think it was up to 2.2 billion, which they forecasted at 1.7 billion. So there's plenty of money there to increase the dividend. They've increased the dividend, I think, by 18%, thereabouts, and that gives them a payout ratio of 40%. And I suppose that's what they aim for, in around 40%. So there's still plenty of room to grow that. I mentioned earlier with Danone that they throw out these statements about how they're going to continue to improve the company. And what I really like about this is that there's actually 2 full pages on. They say, okay, continued progress on initiatives to solidify us as industry leaders. But then they bullet point every single step on how they're going to do that. For example, they're going to expand the customers in the New York trade area. They're going to acquire 39 stores of Dean supermarkets. And look, the list goes on, but it's very detailed. And as a shareholder, I am quite confident they know what they're doing to reach that growth.
Yeah.
So I'm fairly happy. I know you are a shareholder as well. What was your thoughts on them?
For me, they knocked it out of the park. Really great numbers. So I wrote a one pager also for this. I put it up, and almost everything is in green. So it is really really good, strong numbers. And you mentioned about 30% payout. What I like in their dividend policy is that they want to keep growing the dividend. So they are really specific in that and explicit, and you don't see that a lot in Europe, that they're aiming to pay a growing dividend. So I like that. And their dividend growth has been really high over the last few years. Cash flow has been really good. They've been doing major buybacks. So the Ahold Delhaize acquisition from 2016, I think in 2 years from now, you will see that the whole share dilution has been bought back again. And they're doing this mainly out of their cash flow. And you know why the share prices, let's say, went down with 4 or 5%? Because their outlook was a bit disappointing by analysts, because what they said is for our outlook, we are referring back to our 2019 numbers.
Yeah.
And take that as a basis for growth. They see 2020 as an outlier because of COVID-19, where everyone was stocking up. And I love it that they said it, because you know what this tells me? This is conservative management that doesn't want to overpromise. So here's where the UPOT acronym comes from: under promise, over deliver. This is the kind of management style that I'm seeing there. And yeah, I really like that. So I bought an additional 100 shares at 2020 50 yesterday, I believe, for that reason, because it just looks good all over the place.
Yeah, and when I read through the report, it smacks of that Dutch directness that you tell me about often, and they're quite open and lay everything out. And I actually don't think their forecast was so bad. I mean, they're still talking high single digit growth versus 2019, which is still not too bad. But maybe our analysts expected a little bit more. But
they just slot in the numbers of 2020 and then they extrapolate in the future. That's why our next market crash, whenever it will come, will be really bad, because all these numbers that people are extrapolating now on these numbers are crazy. So with Ahold, we know that the company itself is building in a margin of safety. So
yeah,
that's great.
Yeah, and definitely one for me I'd recommend as a buy at these rates. And I think you pointed out, and I have it highlighted here, I love that their management has pointed out in writing that they are committed to their share buyback and dividend program. I love that. It's a clear commitment to us as shareholders, and that's pretty much all you want to see. So no, overall a strong one. And I'm now as I said, I'm now the proud owner of 100 shares. So I'm happy.
Tell me about that. How because you started with put options not long ago. I remember that you were trying to make yourself familiar with it. So how's your experience so far, and how does it feel that your put option got, how you said, triggered?
Yeah. So first of all, I only use them on companies that I want to own. I wanted to own Ahold, but I didn't see the rush in buying them. I don't see their share price going drastically too high. So I thought they were a perfect company to try it on, because they've been hovering between 23 and 24, 24.5. So they're going in between that range. This was the third attempt that I had at 23, and I got triggered. But my cost base is just under 22 at the moment, I think. So I'm quite pleased. I'm quite pleased that it's worked out that way. I got him at a nice price. I would have happily paid 23 for him anyway. So yeah, it was a good experience to do that. I don't know now who I will go with next. I don't know if I won't do it again with Ahold, because I don't want 200 shares. I want to balance out my portfolio. So I have a little bit of maybe thinking to do. But it was a good experience and a good company to trial that with.
Yeah. Oh, nice to hear.
So,
okay, cool. So then we have one consumer staple left, and that's Nestle. And you know, I'm not the biggest fan of Nestle. So where to start? So, man, I don't like this company. Foreign exchange reduced sales by 7.9%. Divestitures had a negative impact of 4.6%. And as a result, total reported sales decreased by 8.9%. Okay. And then their underlying earnings per share. Remember recurring? Here they talk about underlying, another term like that. I don't know why they just agree on a term altogether, right? For non-GAAP or non-IFRS. They should. I think they should sit together, all those CEOs, and then just land on a term and make it a bit easier for us. But again, generally, lots of currency impact because of the Swiss franc. Earnings of 430, which I think are decent earnings. Similar a little bit to the years before. It's always around 4, a little bit now 430. But what was interesting is that and this is really what I caught here, the free cash flow was 10 billion. And there we go again. In total, they returned 14.5 billion to shareholders. And this was my main critique to Nestle, that they're not really organically growing, and they're mainly growing because of in their earnings because of share reduction, but their debt is ballooning. So their debt is now almost going to 30 billion. It's now 27 billion, but just a few years ago it was many, many, many billions lower. So people are so happy with Nestle about their portfolio and doing, but I don't see it in the numbers, if you know what I mean. The only thing I see is that they're growing because of leveraging on debt by buybacks. And maybe I'm too bearish on this, that I don't look objective anymore. So please, if you want to challenge me to listen, please do so, because I'm getting fed up with this company every time I look into it. The issue is it's the number one Noble 30 member, so it has all the benefits of the doubt, of course. But as a company, I would be interested in the low 70s, and now it declined from 100 something, I think, to 97. So for me, it would still need to drop 25 francs before I would be interested in this company.
Yeah, it is a little bit concerning when you see the free cash flow was 10 billion, but they've paid out 14 billion and still increased the dividend as well. There's absolutely no need for them to be increasing that dividend at the moment when they can't cover it by free cash flow, because they're going to have to cut it. They have to. They either have to reduce their debt, reduce what they're paying out, or increase their free cash flow. And I can't see them increasing their free cash flow at a significant rate over the next 2 or 3 years to cover that dividend. So we're seeing parallels here between Nestle and Danone, one that could increase and didn't, and one that shouldn't and has. And funnily enough, we're happier with somebody that's cut it rather than increased it. But when you look at the balance sheet, it just doesn't make sense. And their 2021 outlook, look, they're gearing towards mid-single digit rate. I don't see it. I think it'll be in the low single digit, to be honest myself.
I don't know. I think Nestle is setting itself up for problems 5-6 years down the road. They will have done a heavily leveraged balance sheet. Interest rates will one time go up again. And then that is when the shareholders will be disappointed. It's easy to have high growth now in this kind of stuff if you're buying back so much. But I don't understand why they had 2020 was a crisis year. They could have given all the excuses to take it easy, to even to pause the buyback or something like that. They could have done all of that. Yeah, it is, for me, it is not needed what they are doing. And that's, I guess, my main complaint, because look, they have a brilliant portfolio. Yeah, there's really nothing wrong with their brands in the portfolio and such. I guess the thing that I'm annoyed with Nestle is the financial engineering, which is so much in plain sight. And I have a feeling that I'm the only one with you that is seeing this in plain sight. Yeah, and that's my issue here. Like, am I the blind, or is the rest of the world around me blind? And that's what I doubt about. But probably all the listeners will tell me that I'm the blind one. But that's what I see when I look at Nestle.
I'll actually look forward to some listeners challenging you on that and seeing what comes of that. But I mean, look, I don't have a position in the company, so I don't overly look at them. I just look at them in passing, and for me, they would not pass my initial screen or my fundamental analysis based on the huge debt and so on. So for me, I would swerve them, but I would enjoy a conversation between you and someone who's bullish on this and see what transpires.
Sven Carlin.
Oh, he likes them, does he?
Yeah, he said that Nestle is the one to buy and Unilever not. And I have exactly the opposite view. So I got this question already 5 or 6 times on Twitter, like, oh, what do you think about Sven Carlin then? So it's probably one of the only times that I disagree with him. Because here the funny thing was Sven Carlin is very bearish on Unilever and very bullish on Nestle. And this is the thing, right, that people should remember. And we have this as well. Some kind of value system triggers an emotion in us when we are looking at stocks. Yeah, and based on that, you can always take a bearish or a bullish position towards a stock. I guess the only stock where you cannot take a bearish position at the moment is Microsoft. But for all the other companies, you can always give a complaint about being bullish or bearish, and that relates to our value systems, right? And I really hate financial engineering, because for me it's not value creation. Yeah, so I don't know what Sven's belief system is and why therefore he takes this position. Yeah, because it's not always just the data itself. Yeah.
Yeah. We need to get Sven on the show, and that would be an awesome topic to cover, and have you two battle it out. But it would be I know we've asked him to come on the show, but it would be really nice if he came on, and that would be a nice topic.
But how can I battle Sven Carlin? Come on, he is the #1 European investor from Croatia. Of course, I will challenge him, but come on, compared to him, we are small people. EMF,
of course, but even the big fish are not always right. So it's always good to.
Oh no, we will challenge him.
Yeah.
But maybe I'm from this generation that still pays respect to people that made it and that are just. He's just brilliant. Yeah. So.
Yeah.
Anyway, having said that, we'll give him a hard time then a little bit on this topic about Nestle and Unilever. For the rest, we will be sweet to him if he ever joins the show. Okay, hey, let's do some quick takes. I looked at Nationale Nederlanden Group, and here I want to share that they had pretty good numbers actually. It got punished a bit on the stock market, but I liked it. What I specifically liked is that their net result was flat full year compared to 2019, so 1.9 billion versus 1.9 and a bit billion. So that's for me the headline number. Their operating result increased a little bit, but that had to do with the investment margins and lower expenses. So lower expenses, and it's typically what people do in these times. Again, and they increased the dividend again with almost 8% compared to 2019, and they pay now a dividend of 2.33. Now here I need to come clean, because I remember with Polly's dividend, Polly from the Netherlands, one time he wrote an article about and I challenged him in the comment section, thinking like, come on, and then because I don't know why. But he had it right, and this company, NN Group, has been killing it with the dividend growth, their earnings growth, and now I wish I bought it. It's in the low 20s when it was there in March. It's now I don't know anymore, 33 or something like that. But this is a company. Whenever it gets under 30, I will be really looking at it in adding it, because for me this is a future Noble 30 member 20 years from now. So. Decent earnings, difficult time. That's
cool. You did recommend them before on the show, didn't you? I believe you did.
Yes, and in one of my YouTube videos as well. But in the beginning, I thought like NN, it comes from ING, banking sector, and I thought that the central bank had forbidden all the financial companies to pay a dividend. So I thought, okay, there we go again. But then, insurance companies escaped from this policy, and then and then still paid the dividends. So, and that's when I changed my opinion, because it showed how committed they are. They truly are committed to this. So, and that was for me a game changer in my thinking.
Cool, nice. There was we'll have a quick look at maybe Allianz as well. They're another one that the numbers came out. I know they froze the dividend at €9.60, I believe. But the dividend is well covered, and the numbers seemed decent. The revenues declined slightly by about 1%, 1.3%. The operating profit was negatively impacted by COVID, which again you expect with insurance companies. We've seen this before with Affleck and the likes. And look, the revenues were stable year on year. It was up 8.2%, and over the whole year it was down 2%. But look, it's not too bad. Wasn't expecting a whole lot from them, but look, at least they didn't cut the dividend. They froze it, and I think they'll have a stronger year next year, to be fair.
And they have a pretty nice yield. Yeah. So and this is what I like. I think still the insurance companies are well valued. And yeah, they have a pretty nice dividend. So if people are, and I think it dropped also, I believe, a bit in the share price, so it becomes only more attractive. I think, I don't know, I don't have the numbers with me, but probably 4 to 4.5% the dividend. So for a company like Allianz, I think it's one of the biggest insurers in the world. So yeah, pretty nice.
Yeah, and look, most insurance companies have had a hard-ish year. So, and look, I expect growth next year, or people to panic and insurance to go up. So I expect them to do fairly well next year. So I'll keep an eye on them, and I'll check out their price. If they have dropped a significant amount, they might be worth picking some up.
Yeah. And then the last quick take of companies, British American Tobacco. They grew the EPS with 5.5% again. And their dividend, I believe, with 2.4% or 4%. But yeah, they're really building a better tomorrow. I also saw that they're...
love that.
Yeah, and they are also, how is it? Their non-combustibles were growing again when I looked into the numbers. It's still, just 10%, I believe, of their revenue, if I remember correctly. But the company went quite a bit down. So for me, this is for if your wife allows or your husband allows you to buy tobacco stocks. I mean, yeah, this is a nice high yielder that continues to grow. Its dividend is committed. So and then it's also investing in all this new stuff. So I think it's really it's just doing what it's supposed to do. Let's say like that, and that's what I really like about it.
Yeah, I'm just looking at the 2021 outlook, and they're saying the global tobacco industry volume is expected to be down around 3%, but yet they expect their revenue to grow 3 to 5%.
Yeah, well, that's the nice thing about addiction, right? It's like a boiling frog. You can just hike prices as long as people keep smoking and are addicted to it.
I don't think I've ever heard anyone say it's like a boiling frog before.
I don't know what the English expression is, but yeah, it is like that for me. I mean, come on, you must be addicted if you've seen the cigarette prices being hiked over all those years above inflation. I mean, I think teenagers now must be jealous on their grandparents, what they could buy for the same euro in cigarettes, then they get maybe one puff out of it.
Yeah. I mean, if you're a teenager now, why would you even bother? Why would you start? I don't know.
I don't know. I mean, just people are sensitive to addiction. So, yeah, I mean, it's a sick world from that point of view, to be fair.
So that concludes all the companies I think we have this week. So it was mainly European companies, which was nice. I would have liked a little bit more time to digest some of them, but I'm quite happy with Ahold. Danone could have been better, and we're not too fussed on Nestle. So we will move on to our listeners' questions. What do you think?
Yeah, let's do that.
Okay, so the first question of the week, as always, was Phil. He always gets in nice and early with these. But he's asked us about our portfolio management. Is there any sectors that we are currently overweight, underweight, that you just want to adjust?
Yeah. So before I answer the question, I'm getting tired of these analyst terms like overweight and underweight. It really annoys me because I always need to go to Google what is overweight again and what is underweight. Yeah. So overweight, I guess, is too fat, so too much, and underweight is too little, I guess.
Yeah.
But it always confused the hell out of me. So just please on Twitter respond to me if you have the same, and that I'm really not the idiot in the room here. But having said that, I have a sector that so let's say like that. I'm still in my accumulation phase. My portfolio is 30% of what I need as a target size. So from that point of view, I don't have any sector yet at the limit of what I wanted to be in the portfolio. But if I would take a snapshot of my portfolio today and look at, would I like this allocation to be my final outcome of the portfolio, then I feel like I have too much of energy in my portfolio. But that was by design, because I'm in the accumulation phase. So I bought more energy oil stocks, and then thinking I can leave them on the shelf for 10 years and don't look at it anymore. And that's what I'm doing effectively. Yeah. So and therefore now consumer staples is picking up, and other companies, and who knows, maybe in 2 years from now the information technology sector will be down or something like that. And so usually I notice that certain sectors are in a summer and others are in a winter, like insurance companies are more in a winter or early spring now. So I will probably then buy more of that. But generally, I'm not intending to sell, but I have too much of energy, I would say.
Did you make your mind up on ExxonMobil?
Yeah, Yine. Yes, no. So, if I would sell ExxonMobil now, I feel it's a bit stupid because the oil price is going up and everything. So it's now in a recovery mode. So I want to wait it out, but I want a dollar cost average out. So in general, I want to exit the ExxonMobil position. And I just haven't made a call yet and when I will do that, because every day the price is up. So I feel like, okay, let it ride still a little bit. And maybe if it returns to 60 or 65, I will start selling maybe a third of my position, something like that.
Because I know Phil is doing something lately, and he's selling covered calls on stock. He doesn't mind actually selling.
Yeah, I could do that actually on ExxonMobil.
Yeah, might not be a bad choice.
Yeah. But ExxonMobil has a share price of, what is it, 60 or something like that, or 55, and we're talking
50,
about €5,500 here. It's a lot of money in my portfolio.
Yeah, it's true. It's true. I was just wondering when you were talking about energy, if you made up your mind. Yeah. Look, I'm in a similar situation in accumulation, but I have zero materials in my portfolio, so I do want to add some of them. And my financials and industrials are quite low. I've kind of really focused more on consumer staples, information technology, and healthcare, but trying to get them at a cheaper price. But I'm not too concerned like you, overweight, underweight. I'm not overly concerned about that at the moment. It's just keep adding to the positions that I have, and whatever seems at a reasonable price when I'm buying companies, that's where I put my money until my max position is reached. So
super.
Hope that helps.
Yeah.
Okay, so Dividend Dane asked us about 13 Fs. Do we browse through a few of them, like Berkshire Hathaways, for example, to see what the big funds are doing?
No, I'm not doing that really. Really sometimes for fun, but it's maybe once in 2 years. And why not? Because others are doing it.
That's what Twitter's for, right?
Yeah, but for instance, Dividend Growth Investor always gives a report on Berkshire Hathaways 13F. So they already do really great analysis, so I don't feel like I need to do the same. What I do every year is read the annual report from Berkshire, because I love the shareholder letter. Like, I also like the shareholder letter from Social Capital, from Chamat. So there are 3-4 annual reports where every year I do the letter. Also Amazon for Jeff Bezos. But no, 13F, not because we have enough people doing that already for us. It's a simple answer. How about you?
I should actually share a website that Dividend Wave gave to us last week. It was dataroma.com, and we'll put it in the description below. And it's brilliant for this. You can see all the big funds and what they're buying and what they're selling. I'm the same. I don't really. I use Twitter or social media as my kind of outlet or my news to keep me up to date on that. But I don't deliberately go through them. But it's interesting, and look, you see with ARK and Berkshire, they've invested heavily into the likes of ABBV, who seemed a little bit undervalued at the time. So I like that, because I bought them around that time as well. So it kind of cements my thesis a little bit as well. But I don't actively seek out what they're doing. Okay. And then the last question is from Dr. Inverser. And this is something that I asked you earlier, and I forgot it was here. But What are your thoughts on the dividend cut? Will you guys keep it or sell it?
So I will keep it. So although the CEO really annoyed me and it breaks my trust in this person as such, I feel that 8%, I don't want to be too emotional, because if I look at the numbers just in general, I really like the company. I like the future prospect of the company. And I'm not a pure dividend growth investor as such. I combine it with value investing. I see only good prospects for Danone in the future. So for now, I'm seeing it through the fingers. 8% is really not something that I lie awake from if I compare it to my whole portfolio. For me, a tough decision was Shell. Yeah, they cut 60%. That was a tough decision for me. So I'm giving this a benefit of the doubt because of the whole history of Danone, the product mix that they have, their move from shareholders to stakeholder. I just hope that this guy gets a hard time on the next annual meeting and lots of questions about what the fuck has he done. That's really this guy just needs a proper beating up for a moment. That's how I look at it. But I'm not going to sell it for that reason. No, because I like the investment case too much.
I'm not as committed as you are to Danone. I'm not sure. I'm not sure at the moment how I feel. I'm not impressed with this dividend cut at all. They did not need to do it. I'm definitely going to watch and listen to the Investor Day or whatever they have on the 25th of March. And I'm not going to sell it before then. Well, probably not. I don't know. But for me, there might be better opportunities out there. They're not growing in their dividend now at the moment, but they're not obviously growing in share price either. With Disney, you could see that there was growth potential, and I sold them. With Danone, I don't see that at the moment. I'm not too convinced, as I said, in their short-term growth prospects. Long-term, yes, it's there, but in the next maybe 1, 2, 3 years, I could probably still buy them at a similar price to what they are now. So I'm not as committed to you. I'm going to do a little bit more thinking, and I will be tuning into what they say in next month as well. So I'm holding them for now, but we will see.
Super. Yeah, these are tough decisions because it hits the core of our investment strategy, right? And that's what makes it so hard. I'm not so fundamental like others are, that when they cut it like 1-2 cents, that they will then straight away sell it. Because for Unilever, this guy in the 60s cutting it with 1%, if I would have sold it, what I would have missed out on. Okay, I wasn't born then yet, so anyway.
Yeah.
But that's how I think about it in this case.
There's always opportunity cost, isn't there? And you see companies like Ahold doing so well, for example, and then you have companies like that, Danone. So it's tough. I'm really top heavy in the consumer staples, as I mentioned anyway. So selling them wouldn't be a big loss if I plan to buy them again in the future. But I'm just unsure at the moment. I'm not quite happy with the CEO for doing what he's done. So we will keep a close eye on him.
We need to look him up on Twitter and give him a bit of a hard time. Maybe he changes his mind with a new proposal of the dividend. But we need to give him a hard time, this guy, like we did with Intel.
I was just going to say, the last time we did that, the poor man resigned. So I don't want someone to lose their job.
Well. If they cut an 8% dividend, if they cut my salary with 8%, honestly, they could be sacked from me. So, yeah.
Off with his head. Okay. Very good.
Yeah, on the market square and get his head on the block and chop it up. I think that's what they call in French, right? A guillotine or something like that.
Guillotine, yeah.
Yeah. Okay. So disclosure, this is a joke. Not that we have later the police coming in saying that you threatened him. No, it's a joke. But yeah, no. If I would see him in the bar, I would not offer him a beer, and I would first ask him the question like, "What the hell have you been doing?"
Yeah, give me my 8% back and more sweet.
Yeah, give me 8% back in yogurts or beers. But
Okay,
well,
cool. So look, that's the end of the show. Really enjoyed, and it was good to catch up on some of the companies that I didn't get a chance to look over. So thank you for that. As always, your insights are much appreciated.
Yeah, likewise. And I actually enjoyed it. It's nice to speak about so many European companies and all the struggles we have with them. So thanks again.
The frustration certainly showed this week. I must say, actually, thanks to all the people that have left us a review. There have been some that left us since we last spoke. It really helps. So we'd really appreciate anyone that's listening on YouTube or Spotify, Apple, wherever you are. Just hit the like button or leave a review. It does really help, and we've seen the benefit of that actually over the last couple of weeks. So much appreciated to everyone, and as always, thanks for listening.